From Barangaroo Studios, this is the COB, brought to you by eToro. Invest in ASX shares with $0 commission.
Hello and welcome to Friday afternoon. My name's Kyle Rodder and I'm of course with Daniela Coulier. This is the COB. Fantastic to have your company for this last day of the trading week. In fact, if anything, you can say it's already done and dusted because the market has closed and Danny, it's been a pretty positive end to the week.
Yeah, it looks like the market is up almost probably 2% for the week, and you've had gains from the materials, IT, property and energy stocks over the course of the week, which is really quite impressive. And I was just checking out the ASX 200 in terms of the index level, and my screen is showing me around 7,363. So yeah, there you go. And today we've really had strength across the board with the exception of healthcare and real estate, which were the laggards.
An interesting dynamic indeed. But we may as well get cracking into the three themes because there was one area of the market in particular that performed well, and that was gold. So we'll see if we can get that up there, just that graphic, just for three things. There we are. Gold keeps glittering. Gold stocks performing very well, but perhaps underpinning this conversation entirely, as well as some of the strengths in tech and other areas of the market, is this question: is it disinflation? We had US PPI data last night, and well, it came in negative actually, and that seemed to stoke a bit of a rally.
It did, but if you looked under the hood, you would see that the energy prices were off 6.4%. So that 0.5% fall that we saw in the PPI, which the markets really liked, compared to the 0% change that they're expecting. Really, it's all energy prices. And of course, we've still got a lot of geopolitics going on, don't we? With OPEC wanting to keep the oil price higher, the US having to fill up those reserves that they emptied. So I guess everybody, while the market was really excited, some of the economists are probably a little bit more cautious about really whether the PPI is going to continue to fall. But nevertheless, it put a rocket, didn't it, under the gold price, probably overemphasizing it just a little bit, but the gold price continued to move higher. And that's very much the market saying that real interest rates are coming down. And typically that is when gold performs. And the gold stocks have literally been on fire, haven't they, here in Australia? Even in the US, they've been firmer.
Yeah, absolutely. Up by around 3%, I think, today in aggregate. And it is an interesting point you make too on those energy prices. It was 12 months ago that we had basically prices hit $140 a barrel, and that was just after the invasion of Ukraine by Russia. So maybe some of those effects will start to wear through the data now. We won't see such a big and significant hit from energy in future figures. But we may as well push on, and we will just take a very quick look at some of the major areas of the market that we like to track, and tech was an area of the market that did reasonably well today. Block rebounding, we were talking about it yesterday, down for most of the week, but bouncing back today, 2.25% higher. And as you said, Danny, gold, and we'll get that up too, green right across the screen when it comes to the gold sector. And still tech, but we'll see if we can get there. We go. Gold there, and Northern Star, 4.7%, just very strong across the board. Yeah,
it might be just playing a little bit of catch up, I think, because everyone's been concentrating on some of the other miners, but yeah, it's definitely on a roll, to say the least. And I think some people are looking at the gold price being overbought at the moment. But I have read statistics to say that if we do go into that easing cycle, which is what the bond market has been indicating, then gold has more upside. Maybe short-term pullback, but longer term still positive. And there we have the energy sector. Coal looking a little bit unloved today. Woodside, essentially more gas rather than oil, firmer. But again, a lot of experts are still positioning themselves in the energy sector for longer term. So I suppose we'll be determined very much where the oil and the gas prices go, won't we, going forward?
Yeah, without a doubt. And well, we may as well get to the corporate news of the day because you did see Beach Energy selling off there. We'll get to that story in a second. But first, Bank of Queensland, it flagged a goodwill write-down of $200 million and flagged $60 million in additional costs for its risk program. It says it's doing so to strengthen its commitment to risk management, noting its CET1 ratio sits at 10.71% at the end of the first half. The bank will report on April 20th and is expecting an unaudited cash profit after tax of $256 million. It also said it expects to pay a dividend of 20 cents per share. It also says it's begun a work stream to simplify its operating model through delivering operational efficiencies. And let's get to broker moves now. And Danny, we were talking about Beach Energy before.
Yeah, Canaccord Genuity has lowered the Beach Energy price to $1.60 from $1.63, but retains a hold rating on the stock. It comes after Beach shares hit lowest levels since early April, as it reported a 5% decline in Q3 production to 4.5 million barrels of oil. Equivalent, missing estimates. Morningstar, however, sees no long-term impact from the production miss from Beach Petroleum, and maintains a fair value estimate at $3 a share. Morningstar, however, did lower its full year 23 output target. And I think we have also Evolution Mining. Canaccord Genuity expects June quarter gold production of 173,000 ounces for Evolution Mining, reflecting a 6% jump compared with the March quarter, driven by high output at Red Lake. It says the company has adequate cash in full year 24 to cover major items, including capex, debt repayments and dividends, and reiterates its buy on the stock.
Yes, and last but not least, Ord Minnett downgraded Ansell to hold from accumulate due to the recent price appreciation. The target, however, remains at $30 per share. And you can see Lottery Corporation there too, also in the spotlight with a downgrade from Macquarie. But let's move on, because we wanted to talk about the stock of the day, and it was Technology One. We had Mark Gardner from Macro Capital, as well as Philip Pepe from Shaw and Partners. Here's what they had to say about Technology One.
Technology company and growing, coming out of COVID quite handsomely. It's hit near-term highs, probably for valid reasons, but I'm going to call it a hold. It's basically trading at or above analysts' consensus valuations. It is forecast to grow quite handsomely over the next 2 years, circa 15% per annum. I think the recent share price rally is the market expecting an upgrade.
But look, you absolutely cannot fault it. You're going through their report. Every metric is so bullish and justified. So, I think it's getting to the expensive area, but absolutely wouldn't consider selling all of the holding. There'd just be a hold. I'd probably, from a client standpoint, I'd probably run a bit of a trailing stop on a portion of the position from a practical standpoint. And look, that their forward EPS expectations suggest that PE will drop back down to around about 40 over the next 2 years, which makes it, which then makes it cheap again. So.
Okay, so that was a double hold there, Danny.
Yeah, I just had a little bit of information on Technology One for everyone. May 23rd, the company reports, and it's just worth noting that in the US you've seen such a great performance out of those quality technology companies. Maybe Technology One, since it's at all-time highs, is being ascribed a similar view in terms of a quality company with recurring SaaS revenues, and we'll see whether with this half-yearly result, if they are on target for their $500 million recurring revenues for full year 26. So one to put on the radar.
Absolutely, earnings season's just, a part of earnings season. Those who report out of cycles not too far away, so we're looking forward to that. But rather than get too ahead of ourselves, of course, let's wrap up the week. And to do that, as always on a Friday, Shane Oliver from A&P Capital joins us now. Shane, great to have your company as always. Just has to be a very simple question to start with. It would seem that market sentiment's reasonably buoyant, maybe some hopes that, of course, inflation is coming down across the globe.
Look, I think it largely does come back to the inflation story. Pretty good numbers out of the US on earlier in the week, and then the PPI coming down. We're seeing ongoing evidence that jobless claims are rising, or in a rising trend. So that suggests that the US labour market is cooling down. And I think all of these things are just adding to confidence that we're either at or close to the top in terms of what the Fed will do on rates, and that hopefully, therefore, it won't go so far as to trigger a recession. That said, the risk of recession is still rising, and you can see that in the inversion in yield curves, which is continuing. But I think for now, the market is just feeling more comfortable that inflation is coming under control. And it's not just a US story. We saw the Indian inflation at a 15-month low, low numbers coming out of China, Hungary, PPI in Japan was on the low side. So all of those things I think are helping the market. But as you can see in that chart there, the inversion of yield curves, and that is for the US, is still warning of potential risk of recession going forward. It does sometimes give small signals, but historically, when you get a yield curve inversion this deep, it has often been followed by a recession. Interestingly, one of the aspects of the yield curve that the Fed in the past has looked at quite closely, and that's shorter dated yield curve gaps. That's the gap that they tend to look at a 6-quarter bond yield less the T-bill rate. I was on that chart there looking at the 2-year bond yield less the Fed funds rate. Whichever way you cut it, it's inverted. So even though the Fed, I think a year ago, was not too concerned about yield curve inversions, they'd have to be more concerned about it right now.
Yeah, and it's interesting, Shane, because you've had quite a few of the central banks or the head banks of countries, like Singapore has gone into a pause, I believe, today. They had poor growth figures that came out. Canada, Bank of Korea. So there is a move. What are you looking for in terms of the Fed for the May meeting?
Well, that's an interesting one. I mean, our base case is that they might go again, or probably go again, but I'd have to say it's a very close call. When I last looked, something like 13 basis points of a 25 basis point hike had been priced in by the market. So the money market itself is having an each-way bet. And when you run through the economic data, it's been literally all over the place in terms of what it signals for the Fed. The core inflation numbers, the CPI numbers that came out earlier in the week stuck at 5.6% for the core. I mean, that would argue in favour of another move. Fed commentary from Fed speakers would likewise point in that direction. But by the same token, when you're looking at the payroll numbers, we are seeing a declining share of US industries reporting gains in payrolls, which is quite interesting, even though the headline number was still quite solid. Wages growth looks to have slowed. We're seeing a rising trend in jobless claims, job offers slowing down. So there's a lot of data coming out suggesting that, the Fed has done enough. And at the same time, we saw from the minutes earlier in the week, Fed staff now forecasting a mild recession later this year. So all of those things would suggest, well, maybe they should have a pause. So I must admit, I'm a bit on the fence on this one. I reckon it's a really close call. If I was pushed one way or the other, I'd say, yeah, one more hike. But I do think May is going to be a close call, and obviously data in the next few weeks, because there's still way to go before we get there. Data in the next few weeks would blow that in either direction.
On that sort of point, maybe turning somewhat as well to earnings season coming up in the United States, which will naturally be crucial, is that you mentioned the R word as we're referring it to this week. The Fed members themselves didn't speak of recession, but of course it was in their sort of economic liaisons, or whatever you wish to call them, that the warning was perhaps given that the US economy could head to a mild recession. Despite all that, the softer CPI as well, expectations rates could potentially remain higher for longer. Equities are rallying, and we're going into an earnings season that may see earnings contract. I mean, is there a way that we can kind of square that circle, to say the least? Because it would seem that the bad news is good news narrative is still supporting equity prices.
That's right. And if you get good news on earnings, it might be interpreted as bad news in terms of what the Fed does. So I guess it remains to be seen on that front. We have seen a bigger than normal downgrade to March quarter earnings expectations over the last couple of months. We have seen, well, it looks like the US economy is still growing. We've seen a decline in the value of the US dollar. So some of those things would suggest that market expectations for a 6% decline year on year in US earnings for the 12 months to the March quarter might turn out to be too negative. In other words, we could see, again, some upside surprise to earnings outcomes as they unfold. So my inclination would be to think they might come in a little bit better than the market's currently fearing. If that's the case, then it would probably be seen overall as supportive of the equity market, even though you could run a good news is bad news narrative on that front. But I think if the earnings numbers are sort of okay-ish, a 6% fall year on year would imply a flat outcome in the quarter itself, because the previous quarters did actually have a fall sequentially in the quarters. So a flat outcome or a slight positive outcome in the quarter itself could be interpreted by the market as, an okay sort of result, particularly if we're coming into an environment where interest rate pressure will start to diminish.
Yeah, and maybe we should shift home to Australia. And have your views changed at all around those employment figures that came out in terms of what the RBA might look to do next?
Look, not really. The numbers themselves were stronger than we were expecting. We were expecting something like a 20,000 gain in employment and a rise in unemployment to 3.6%. Obviously, the numbers were stronger than that, 53,000 new jobs, unemployment staying at 3.5%. So you'd put that in the camp of indicators arguing for another rate hike. I guess the flip side to it, to me, is that the labour market is a lagging indicator. At least the labour market is not getting any stronger. We are seeing job vacancy numbers in decline. I think from the ABS, they've now fallen for 3 quarters in a row. The Indeed job offers index is well off its highs. And in the meantime, we're seeing other indicators of slowing demand in the economy and easing inflation pressures, much like we're seeing in the US with last week's or the week before monthly CPI numbers. So I think all of these things suggest that the RBA should be on hold at their May meeting, but it's going to be a pretty close call, and there is a lot riding on the CPI numbers that come out in a couple of weeks' time. If they come out on the high side and don't confirm strongly enough the message from the monthly number that inflation is coming down, then obviously that would concern the Reserve Bank and they could go again. My feeling, though, would be that if they do that, then they are making a mistake. They would risk making a policy mistake, because inflation and the jobs market are both known to be lagging indicators of the state of the economy, and therefore paying too much attention to them in driving interest rates would run the risk that they end up over tightening. And as you were pointing out earlier, Danny, you are seeing a lot of central banks around the world sort of going into pause mode. They've all reached what you might call a restrictive policy, and they're seeing signs of things cooling down, and therefore feel that they've got scope to pause. And I think the RBA just needs to give it a bit more time rather than just wait 1 month before then starting to raise interest rates again. But I have to say the risks are there, and with the property market hotting up as well, it's another risk in there that the RBA might start to worry. Well, if house prices start going up again, then you remove the negative wealth transmission channel for monetary policy in terms of the way it impacts the economy. So that risk is certainly there on the upside for rates, but I think the more sensible outcome would be for the Reserve Bank to wait a bit longer.
Shane, may as well leave it there because it's a great note to leave it on. But we really appreciate your time as always, and we hope you have a wonderful weekend. Dr. Shane Oliver from A&P Capital there.
Thank you.
Okay, well, let's look a little bit on what's coming up overnight, because we do have some relevant information to sort of digest, both from a macro and micro point of view. US retail sales expected to contract over the course of the month, but I think the big story could come out of earnings tonight.
Yeah, absolutely. So the large banks, JP Morgan, Wells Fargo, Citi Group, and also I think you said Republic Bank, one of the smaller ones,
yes,
might be reporting. But these banks will hopefully give us a better indication of how the US economy is performing. Of course, whilst that is really important, a lot of people will actually be looking at the outlook, and if they provide any colour there in terms of what the outlook is, what's going on in the credit markets, are they seeing a tightening there? And it could turn out to be a complete fizzler, but I think very much everybody is looking to see what the fallout is after the March banking issues that the US had. United Healthcare is also reporting overnight, so that's a big one for the Dow, just worth noting. And then we have up on our screen a number of large companies reporting over the course of next week.
Yeah, and a few retail favourites there too. Netflix, a bit of a barometer for consumer behaviour. We were sort of joking at last quarter that we've gotten to the point now we have to choose between Amazon Prime or Netflix. We can't have both. It's just some of those challenges you run into when you live a tough life like I do. But here we go. That's the other macroeconomic data coming out next week. China GDP, as long as with the other sort of elements of the data dump, so to speak, that will be released. But RBA minutes off a little bit of colour on its last decision, and then some global PMIs. We already mentioned US earnings there as well.
And I'm just quickly going to add that there are a few companies reporting next week. We've got Brambles, Challenger, quarterly report from Evolution, Iris has an investor day, quarterly production from Rio, Santos, BHP, Woodside, and a few stocks going ex-dividend as well. So some more news to be coming to the market.
And let's just do the leaders and laggards now. Having a look first at the leaders quite naturally, and there is a lot of
gold. Lithium.
Absolutely, you can see it on your screen. Up 6% IGO. Silver Lake Resources, another one, up by 6.18%. As I mentioned before, quite naturally, the All Ordinaries Gold sub-index up by about 3%. I'm not too sure in terms of how high it is for the year, but at different stages, especially around that bank crisis, was up 11-12%. So I dare say it's at least double-digit gains for that gold portion of your portfolio. There's some people that just only have gold in their portfolio, of course, would be doing very, very well for themselves. Allkem in there too. A lot of chatter in recent days about sort of bullishness in that company in particular, perhaps being the potential winner out of all, biggest winner, I should say, out of all Aussie lithium stocks.
And I think my memory is failing me, which is terrible, but it has, it's not graphite, it's got something else, I don't know if you can remember, which makes it's sweet, it's offering more attractive, definitely. Allkem. And Pilbara Minerals back in favour. Energy, Lottery Corporation, I think there was a downgrade there from one of the brokers today. Paul Magellan still not finding any love, continuing to fall. And Helios, I'm not sure what's going on there, but that's also off about 4% today.
Yeah, and we did say that it was sort of, I guess, a bit of energy, it was a bit of healthcare, a little bit of real estate as well, that were coming under pressure today. And, sort of fascinating enough because, we talk obviously about interest rate dynamics and what was happening at the long end of the yield curve and how that supported some areas of the market. And typically, real estate and some other areas of the ASX 300 might benefit when those rates come down. But, it's a more nuanced story, I guess, at the moment, especially when it comes to real estate. There's a lot of uncertainty around there. Healthcare is interesting, but it has run up reasonably strongly at different stages of this week as well. So it could be an element of swings and roundabouts when it comes to those names, and it's hard to go past Magellan, of course, as being potentially one that investors are carrying the bag on an underperforming company. They're one that has experienced a lot of pain recently, quite naturally. But there we go. We've got just some of the small caps that we want to run through now. Let you run your eyes over that yourself. 28% gain for Mindax. Let's go to the laggards there.
For Medical, which has been on quite a run as well. So that was up strongly today.
Yes, and here are the laggards here. Nojevois Global, which I actually had hoped would be on this list, only because I actually Googled what they do today. And they are also in battery minerals, and their whole, I suppose, point of difference is, I guess, a more ethical and clean way of mining those. So I was like, you know what, that's right up my strata. I might keep an eye on that one in future. Maybe it was a sign. Maybe it was a sign from the investing gods. I'm not too sure. But would be remiss if we didn't have a bit of a discussion before we go about the view today.
Yes.
You provided another cracker. Take us through it.
Well, I hope everybody enjoys it because I had to get up extra early, 6 o'clock for a webcast with David Rosenberg, known as Econ Guy on Twitter. And look, he had some luminaries from the Merrill Lynch days, including the famous Bob Farrell. And if you don't know who Bob Farrell is, please Google him. You could hear a pin drop on the webcast, And everybody was, well, I think Rosenberg is probably about 60, and then there was another guy around mid-50s, and then there were the older gentlemen there. Between them, there was, 200 years of, literally probably 200 years of experience in stock markets. But look, I basically jumped on the chance to summarize what Bob Farrell was saying about the markets. Really clear, this is not advice, but he is one of the legends. His 10 investing rules and guides is really worth reading over. And I think he had some really interesting stuff to say about the US share market. So that's in the View today. And of course, if you'd like to read it, you have to subscribe to the newsletter.
Absolutely. There's about, I'd say, 35 years of experience on this desk. Unfortunately, almost all of it is Danny's. So unfortunately...
don't say that. Everybody will know my age.
Your experience, and certainly my lack thereof. But I digress and I joke, of course. But well, Danny, we may as well wrap it up there for another week. Remember, folks, you can catch up on all the latest views and news on our website and app. Until Monday morning, make sure you have a great weekend.
Bye.
The COB is brought to you by eToro. Invest in ASX shares with $0 commission.